So let me just talk briefly about what is the actual outlook for the economy per se. I'm a strong believer. I'm a strong believer that history repeats itself. As a financial analyst, it is my job to identify the global trends or patterns over past and see how they may be relevant to the Indian financial markets in the coming time. Today, I would like to share some of the insights that I've gained from studying the various equity markets. And the first thing that I've seen and studied looking at all the global markets over the past 70, 75 years is the moment the per capita income goes up from US dollar 2000 to 5000, there's an inflection in the equity capital market. We have So let's look at various countries, and mind you, I've taken just 3 countries as an example. You can go back and check for all the countries, whether it's developed or developing or which have come forward in the last 20, 30, 40 years. Just for the sake of convenience, I've taken 3 countries and benchmark what is the return that they have made. These countries are Singapore, Korea, and China. I would like to draw your attention to the time periods so that there's a little bit of a sequencing out there for each of the countries, and you would probably recollect how each of these countries have actually developed over a period of time. Singapore, the per capita income increased by 2.4%, by 2.4 times in 7-year time period. Korea's per capita income grew between 1983 to 1989. It went up by 2.6 times, again from $2,000 to about $5,800. China's per capita income went up from about $2,000 to about $5,600 in 5-year time period. The time taken for all the 3 countries under study in terms of doubling their per capita income is between 5 to 7 years. During the same time period, the return of the underlying index, and I would like to draw your attention to the table below, where I've captured one of the returns. Just for clarity for people sitting behind, I'm just going to read out. The long-term return that China has given the equity market since inception is just 10%. Korea has given 8%, and Singapore has given a return of 5%. However, if you just slice the data during the time period where we've seen exponential growth in the GDP per capita, the inflection point of 2000 to 5000, the return in China is 11% as against 10%, and this is, we are talking about CAGR return over a long period of time. In case of Korea, the return is 33%. The equity market, underlying equity market, gave a return of 33%. Similarly for Singapore, it is 12%. My explanation why the equity markets do well during this phase is very simple. At about $2,000 per capita income, which is about 16.5 to 17,000 rupees, a large portion of the income actually goes into necessity consumption. That's your food, rent, etc. As the income level rises, the necessity expenses don't rise in the same proportion, right? And hence the amount available for discretionary spend increases. This spend on consumption has a multiplier effect on the economy. This in turn leads to improved demand, resulting in higher earnings and in better equity market. Let me nix a question, and I'm sure based on looking at the data of China, one would say that, look, China market has not really done well, so how is it actually supporting your argument? Just to remind you, China's growth is actually led by capex growth, or infra-led as we say. Chinese economy is more capex heavy and less consumption heavy, and hence, despite the per capita income increase, the Chinese economy did not have any consumption boom or the multiplier effect in its economy, and that was very minimalistic out there. All this is fine. What does it actually mean for the Indian economy, and how does it actually help the Indian investment? So what we have captured out here is India's per capita GDP, right? We are currently at about $2,389. According to me, India is on the cusp to take off. If I take a nominal GDP growth of 10.5%, which is in line with the last 15-year averages, we should take about 9 years to double the per capita GDP to about $5,400. I'll be really disappointed if we take that long. If I go by the history, most of the countries actually went up from $2,000 to $5,000 in a time period between 5 to 7 years. So either my assumption is wrong or the history has to be proved wrong. My sense is the way things are looking, we'll probably do much better than what we have done historically. My personal take is India should do much better than the rate at which we have grown in the last 15 years, and this is something that even my previous speaker was alluding to. I've taken a nominal GDP growth of 10.5%, which is nothing but 6% GDP growth and 4.5% inflation. We can challenge these assumptions. My sense is India's actual potential to grow in GDP terms is about 7.5, and if that's the case, you should see much faster growth in the per capita GDP. According to me, this is actually the golden era for the consumption economy as we speak in the next decade. My investment thesis is we will see a much higher multiplier effect on the Indian economy because of this consumption boom. With India's per capita income entering the golden phase, we have examples of China, Singapore, Korea, whose equity did much better than the long-term averages during this period. We can expect the same from the Indian equity markets over this time period. Just to recapitulate, the Indian markets have delivered a return of between 12.5% to 15%. Need I say anything more? What to expect in the coming decade?